Welcome to Taking Stock, where today I have the pleasure of welcoming Tim Lincoln, our Managing Director and Chief Investment Officer, who's joining me, Kien Trinh, Head of Research, to stream to you all things share market. Welcome, Tim. It's wonderful to be able to finally enjoy our new freedoms here in Victoria.
Oh, it sure is, Kien, and what a welcome relief to be able to enjoy a round on the golf course yesterday because it was outside of our 5K, 10K, and 25K restriction zones. It was certainly a wonderful thing, and freedom feels great, and get out there and enjoy life again.
Yeah, and for the share markets, the month of October was pretty flat for our market as it grapples with investor concerns around the debt issues among the Chinese developers and also the inflationary threat leading to higher bond yields as well. And this, of course, has led the RBA to abandon its yield target in a sign that interest rates could rise earlier than anticipated. However, in our video last week, we did remind investors not to be too concerned because of the positive correlation of rising interest rates to the equity markets, especially in a low interest rate environment, Tim.
Yeah, Kien, we need to separate those facts from the noise, don't we? Not only in a low interest rate environment and where rising economic activity is supporting equity markets, but also central banks have also provided a safety net. In fact, the RBA is continuing with its quantitative easing program, which involves 4 billion a week of government bond purchases until February. Although global central banks such as the US and the EU are expected to taper these bond purchases, they'll do it in a way so that it does not disrupt economic recovery, which is terrific. So it'll be very controlled. As the Federal Reserve said this week, the committee is prepared to adjust the pace of purchases if warranted by changes in the economic outlook.
Yeah, that's right, Tim. And this safety net has also led to rampant speculation within the markets. In fact, 35% of companies in the All Ords index makes no money, but this group of stocks is up about 50% on average for the year. Meanwhile, you've got corporate insolvencies as well, and they've continued to track well below historical levels. And this appears counterintuitive given that the government debt protection measures ended in January this year. However, a look under the bonnet reveals some interesting facts. Recent lockdowns in New South Wales and Victoria meant that the Australian Tax Office and banks have been quite lenient with the repayment of overdue debt. Also, many companies are awash with cash following capital raisings during the depths of the pandemic, and this has spurred record levels of mergers and acquisitions. But as central banks begin to taper their bond purchases, it's important for us to ensure we invest in financially healthy businesses because over the long term, quality stocks tend to prevail.
Yeah, they sure do, Kien, and there's some amazing statistics there. It certainly is a minefield trying to select stocks that are quality, healthy businesses and avoid those that have weaker balance sheets and higher debt levels because we know they're still at risk of failure. So it is still very much a minefield, but very difficult to decipher when everything's going up, isn't it? But in no doubt that momentum is reflected strongly in our star stock performance figures to date. And as you can see on the charts here, over the long term, from 3 years and onwards, both our star growth stocks and star income stocks have meaningfully outperformed the market, which is terrific for our members and investors. Early last month, we transitioned our star growth stocks to our optimized quant model, and we have begun to see the benefits flow through almost immediately with the October star growth stock return at 3.2% compared to a flat market performance. So nice outperformance there already, Kien. So well done to you and your team and all the rigor and the testing we've done over time. Even our star income stocks perform well relative to the market. In fact, in the last 6 months, our star growth stocks have significantly outperformed the All Ordinaries Accumulation Index, returning some 11.5%. Over time, we expect this performance to flow through to our 1-year return figures as well. The strong performance here has also flowed through across our 4 strategies that we educate our members on, Kien, with the 2 technical indicators, SD30 TSR and SD Max, available to members who are sensitive to the current market's volatility by allowing them to move to cash when stock prices fall, but re-entering when stock prices rise again. Both of those strategies doing their job beautifully through this whole pandemic period. For the moderately trend-sensitive investor, SD30 TSR has done terrifically well and proven the best strategy over the longer time frames as well. Meanwhile, for those that follow the SD Max strategy, should be very happy also, as the indicator has done exactly what it's designed to do. Although it appears not to have performed well or as well relative to the other strategies over the last 3 to 5 year time periods, it allowed the highly trend sensitive investor to move to the safety of cash to protect capital, then move back into the stocks as they recovered, providing that peace of mind. Now, also, Kien, in keeping on with the performance of star stocks and the theme of that performance, our funds have had a terrific October as well, whereby we continue to block out that macroeconomic noise and focus on maintaining portfolios of high quality star stocks. The funds may not outperform the markets during a raging bull market when all boats are floating, even those with gaping holes, but our funds and strategies certainly have provided our investors with very solid returns, with the comfort of knowing that the companies we invest in and the portfolios we construct are of purely quality businesses, allowing our investors and ourselves to sleep well at night. The Lincoln Australian Income Fund continues to deliver a grossed up yield to investors of circa 10% per annum. That's a tad better than leaving your money sitting in a cash bank account earning about 1 to 2% interest. So the income fund is doing exactly what it's designed to do, which is great. Meanwhile, Kien, the Lincoln Australian Growth Fund has completed its transition to the new Stargrow stock models, and it's maintaining an equally weighted portfolio of approximately 30 above $500,000 traded a day liquidity Stargrow stocks and borderline Stargrow stocks. The 30 stocks we select are ranked based on price target revisions, whereby we want to include stocks with the strongest positive revisions. The Lincoln Australian Growth Fund continues to deliver very consistent long-term returns to its investors, for which we're really proud of. The US funds continue to do exceptionally well also. The flagship hedge fund that protects investors against currency fluctuations and risk delivered close to a 9% return last month and 32% in the last 12 months. The US funds can build portfolios using very similar strategies to how we construct our growth funds here in Australia, with financial health and similar golden rule 2 growth factors being the key criteria. However, the US market is so much larger and diversified and offers us the opportunity to invest in large-scale growth and tech businesses in an area where there is massive global appetite at present for those types of businesses. We select stocks that meet our metrics from both within the S&P 500 and those we expect to be S&P 500 stocks in the future. Some of those really interesting names include Enphase Energy, who is a global leader in microconverter-based solar and battery systems, which is huge at the moment. And Enphase, just in the last rolling month, has been up some 64%. So new age tech business. Etsy, who is arguably the fastest growing online marketplace in the world, where people, buyers and sellers come together to make, sell and buy in collective unique systems. They've been up some 38% in the last rolling month. Arista is a global cloud networking solution company. Now, these companies aren't small. They're huge businesses, but they're also growing. They were up 48% in the last month. Kinsale Capital Group. Effectively, they insure things that standard insurance companies won't cover, and it requires a unique high-tech system and specialised underwriting techniques to roll their business out, to take the risk that they take on, up some 23%. Under Armour, who are a global sports equipment company that manufacture footwear, sports and casual apparel. again, traditional, more retailer. They've been up 21%, so huge momentum. And of course, there are other big names that we also invested in the Lincoln US funds, and that includes Apple, Alphabet or Google, and traditionals like Coca-Cola, even ResMed, which is duly listed on both the Aussie and US markets, are in our fund. So it's great to see that a business that was founded in Australia is certainly shaking it with the big guns in the US. So with our managed funds, Kien, we're making hay while the sun is certainly shining, and taking advantage of this low interest rate environment.
Yeah, certainly some innovative names there, Tim, but turning our attention now to some of our star stocks. And of course, one of them is quite innovative as well. And the company that actually benefited from COVID lockdowns, leading to higher food delivery services, is Stargrow stock Domino's Pizzas. Now, the share price has reacted negatively to its trading update this week, and that was due to slowdown in sales over the first 18 weeks of financial year 22, with same-store sales growth of around 4%, down from 8% in the prior period. But it was also hit with rising cost pressures, while sales in Japan are tracking below management expectations. And the Japanese market represents around 35% of their group revenue. Our team will continue to monitor this stock very closely in coming weeks, and just to see the impact of those earnings revisions, Tim, especially to Golden Rule 3 outlook and active risks.
Yeah, for sure, Ken. We'll be keeping a close eye on what you guys decide to do as well, because we hold an equal weighted place with Domino's in our Lincoln Australian Growth Fund, of course. So see what happens there. And for those that are trend sensitive, they should keep an eye on SD30 TSR exit trigger, as that's around $115. And also the highly trend sensitive should now be out of the stock, as SD Max has been triggered. Despite the share price setback though, Kien, the company has generated a strong return for investors since it was included as a borderline Stargrow stock in May 2020, and even stronger if members have ridden through the ins and outs of its journey as a star stock when it was first flagged. So certainly some great returns there for our members over quite a long period of time in Domino's. Also great to see both the CEO and chairman, Don Mage and Jack Cowan, respectively, have considerable skin in the game, Kien, under Golden Rule 7.
Yeah, that's right, Tim. And meanwhile, we've had the bank reporting season, and it's provided some mixed results. With star income stock Westpac, they missed market expectations, and that was driven by falling revenue and a 460 million rise in costs in the second half. And another drag on its result was this 670 million loss posted by the institutional bank, which services the large ASX companies, and that included also a 446 million fraud claim from the foreign finance scandal. Now, meanwhile, its net interest margins fell slightly as the bank chased volume at the expense of margins. Now, these kind of issues has led to earnings downgrades, and is the reason why the bank is now trading at the highest gross dividend yield among its peers at over 7%. Now, the stock goes ex-dividend today, but despite this, we believe dividends will remain sustainable, and that's due to the bank's very strong capital position and also their unstretched payout ratio at around 75%. In fact, the bank announced a 3.5 billion off-market share buyback, which should reduce its shares by about 4% and deliver investors an additional franking credit from the capital return.
Yeah, nice, Kien. And the bank has maintained its commitment to deliver a cost base of $8 billion by 2024, down from 11 billion over the past year. So that's nice to see that commitment to cost reduction. Those who believe that Westpac is in the early phase of a turnaround story could view the share price weakness as a buying opportunity under Golden Rule 4.
Yeah, and talking about the banks, Tim, turning our attention to the week ahead, both National Australia Bank and James Hardie, they will be reporting on the 9th of November, while AusNet Services is due to report its interim on the 11th of November. And also with the AGM season still underway, a handful of stocks are expected to provide operational updates next week. So please refer to the corporate calendar and strategic comments once these details are released. Meanwhile, Macquarie and ANZ, they go ex-dividend early next week as well. And for those who are highly trend sensitive, we had several bullish SD Max signals this week, starting with Altium, Aurelia Metals, Accent Group, GUD Holdings, Hansen Technologies, JB Hi-Fi, Netwealth, and Super Retail Group. Meanwhile, these trend-sensitive investors should consider removing exposure to Domino's Pizzas, Infomedia, and Nanosonics, which turned bearish on the SD Max. And for those who are moderately trend sensitive, APA Group, they triggered an exit on the SD30 TSR, which is the SD 30% stop loss from their highs. And this week we put the spotlight on Macquarie Group. The company is a global financial powerhouse with operations across 4 major units, being asset management, around 33% of their earnings, banking services around 12%, commodities 43% of their earnings, and investment banking at 12%. Now, profits over the first half beat consensus expectations by 5%, and that was driven by higher fees from mergers and acquisition, also stronger trading revenue from the commodities division, annuity-style income activities also helped, and banking profits and acquisitions in asset management also drove the result as well. But the group is undertaking a 1.5 billion capital raising, but they also paid out 1.2 billion in dividends over the year to date. So a few investors may be wondering whether it would be better for Macquarie to retain the shareholder capital instead of reallocating those funds, because if you think about equity raisings, they can lead to a dilution to profits, specifically a dilution to return on equity and also their dividends per share. Now, in theory, this makes sense. However, from a practical standpoint, cutting dividends often creates this negative connotation that management has lacked confidence in the business outlook, which is Golden Rule 3. And the share price would also lose support from large income investors, which is also part of our Golden Rule 4 as well. Moreover, though, with its price at record highs above $200, an equity raising near these prices should have a lower dilutionary impact because fewer shares are issued. Meanwhile, keen-eyed investors may have also noticed that Macquarie lowered its target dividend payout ratio to 50 to 70% of earnings from 60 to 80% at the July AGM. Now, this allows the company additional flexibility to support future growth, having deployed around 5.5 billion in capital over the past 12 months. However, we do not expect this to lead to negative dividend revisions, because the current forward payout ratio at 55% is currently near the bottom of the revised range. And with a forward gross dividend yield of just over 3%, Macquarie is suitable for both income and growth investors. And as we mentioned earlier, they go ex-dividend on Monday, the 8th of November.
Yeah, terrific story, Kien, for the long term for growth, both the growth and income investor. Terrific stuff. And gee, hasn't the share price had a terrific run over the last 3 months, gone up around 30%. So terrific success story. We do hold an equal weight position in Macquarie in the Lincoln Australian Income Fund. However, it doesn't currently have a spot in the Lincoln Australian Growth Fund, as it's not ranking in our top 30 stocks based on our price target revisions model that I mentioned earlier. However, we do rebalance the portfolio to an equal weight position on the 7th of each month, where we look at those new rankings relative to price targets. And on the back of what you've just articulated, perhaps there'll be positive revisions for Macquarie, which could move it up into our top 30 stocks, and therefore we may be re-entering Macquarie in the not too distant future, Kien.
And with the bank reporting season now in full swing, this week's relevant question is, how can investors use Stockdoctor to monitor upcoming dividends? Stockdoctor has a comprehensive range of tools to help income-seeking investors track their income and manage upcoming dividends. And for those looking for dividend opportunities with upcoming payments, you can refer to the pending dividends section under the tools heading. From here, the companies are listed in order according to the next available dividend date. Stockdoctor also provides an estimate of the dividends per share. And another way to monitor upcoming dividends is via the corporate calendar, where you can filter for events types such as ex-dividends. You may also wish to create a custom watch list of companies or select a desired portfolio, such as the star income stocks. Here you can sort the companies by ex-dividend dates and view other income fields such as franking, the payout ratio, the forecast dividend yield as well. Meanwhile, the dividends tab provides members with further details at the individual stock level, including a history of dividend payments and the forecast metrics as well. And of course, you can find some of these information under Golden Rule 2 and Golden Rule 3 on our 9 Golden Rules screen. So Tim, what strategy does the fund employ to manage the dividends?
Yeah, thanks, Kien. Pretty much the same as what a Stock Doctor member should be doing in the way they manage their income style portfolios. The Lincoln Australian Income Fund is an equal weighted portfolio of most star income stocks. But we want to try to maximise the yield we receive as best we can without moving too far away from that equal weighted approach that we know works so well. So we'll generally have a bit of a target yield for each quarter that we want to deliver to our unit holders and investors. So based on that and based on its next ex-dividend date, and in order for us to, where we've got franking credits available to us, we'll start to position our portfolios to maximise that yield early, ideally 45 days if we've got to buy additional stock to qualify for the franking credit. So we'll position the portfolio early to maximise those yield in certain stocks that are about to go ex-dividend next. So it's just that little bit of maximising your yield that we do on an equally weighted portfolio. But I think, as you've mentioned, it's about keeping your eye on those ex-dividend dates and positioning early relative to the franking credits that might be available.
Yeah, and definitely Stockdoctor has all those tools and insights for you to help you out there as well. But thanks, Tim. Again, for your insights are very valuable, especially around your thinking with the managed funds.
Yeah, I might have provided a lot of information there, but I feel it's necessary, Kien. We love to be transparent and offer our insights into how we go about things. So, we're managing large funds now. We've almost got $860 million under management across our Aussie and US funds. So it's a lot of money, but so how we manage that is a bit different to how a retail investor will go about it, because obviously they're not as liquidity constrained as we are. But overall, it's I love to provide that insight and transparency, Kien.
Yeah, and I'm sure our investors really enjoyed listening in as well, Tim. But to summarize, interest rates could potentially rise sooner than expected, Tim, but investors should not be concerned. Remember, interest rates remain very low by historical standards, and rising rates from here represents stronger economic growth. In addition, you have central banks and they are continuing to support financial markets, although this has led to some complacency. So investors should continue to focus on those financially healthy businesses, because in the long term, quality stocks and those with very strong earnings and cash flows tend to prevail. Have a happy, healthy, and prosperous week, everyone.